For this session, we will talk about your leases under PFRS 16. So before, we have your standard that is PAS 17, but now it was superseded by your PFRS 16. So when we say superseded, this PAS 17 was already removed and a new standard was made in exchange of that old standard. So PAS 17 before talks about leases. PFRS 16 talks also about leases. So what's the difference? Before, in PAS 17, we have your two entities in the contract of a lease. So lease or rent is normally a contract. And in a contract of lease, there are two parties. In any contract, there is normally two parties. So in a contract of lease, there are two parties. So what are the two parties here? First, we have your lessor, and then we have your lessee. So your lessor, of course, is the one who owns the property, and the lessee is the one who rents the property. So the one who rents is the lessee, the one who owns the property and rent it out to others, and rent it out to others is the lessor. So since this is a two-party contract, you should have placed in your mind that this standard is a mixed account standard. So what do we mean by a mixed account standard? Because normally, guys, a standard is a loan account standard. So for example, PAS 2, it only talks about inventory, which is an asset. PAS 16 talks about your property, plant, and equipment, which is an asset. PFRS 16, in this way, or PAS 17, is a mixed account. Why? Because it provides for two accounts, an asset and a liability. Why? Because again, it is a two-party. Of course, the lessor has a receivable and the lessee has a liability. So the asset portion here is known as your lease receivable on the part of the lessor, and the liability portion here is known as your lease liability on the part of the lessee. Okay, so having placed here that PFRS 16 is a mixed account, therefore, as we go through, you will learn that you are accounting for two persons, accounting for a lessor and accounting for a lessee. Now, we go back to our first topic, which is PAS 17 superseded by PFRS 16. So, having now known that in standard relating to leases, we have two accounting, lessor accounting and lessee accounting for your lease receivable and your lease liability. Now, what changed as to PAS 17 and PFRS 16? So in your PAS 17 before, PAS 17, what we have is the list for your lessee and your lessor. So for your lessee before, we look whether it is an operating lease or a finance lease. For your lessor, whether it is an operating lease or a finance lease. That is under PAS 17. So take note on the part of the lessee, you are to categorize it. However, under PFRS 16, what changed is that for the lessee and for the lessor, for the lessee first, you only have a finance list. For your lessor, you still have operating list and finance list. Later, we will discuss why under PFRS 16, we have only your finance list. Okay, so since you already know the difference on your PAS 17 and PFRS 16, and the reason why PFRS 16 is considered as a mixed account, that we need to recognize two items in a contract of lease, that is your lease receivable and your lease liability. We dwell now on leases per se under PFRS 16. So to start, we must define what is a lease. So a lease is defined under PFRS 16 as a contract which conveys the right to control the use of an identified asset for a period of time in exchange of consideration. So generally, the lessor has the asset. So what happens? The lessor and the lessee will enter into a contract. So the lessor gives the right to control the use of the asset to the lessee, and the lessee will provide a consideration to the lessor. So that's how your lease works. The lessor has an asset. The lessor now conveys to the lessee the right to control over the asset. So take note of this. Because of the change on your definition with your right to control the use, what comes into your mind? It does mean that there is an asset on the part of the lessee. Why? Here kasi, kay lessee, since you have your right to control already, as you have remembered in your conceptual framework, your asset is defined as the right to control. Since you have the right to control, you should recognize as an asset. You should recognize it as an asset. Now here, take note in a lease, it provides a right to control to the lessee. Therefore, you have an asset. That's why, guys, in your past 17 before, you have your operating lease and finance lease. In your operating lease, you do not recognize an asset. In your finance lease, you recognize an asset. So that's why, under past 17, your operating lease was removed. Why again? Because of the new definition of the lease. The new definition of the lease is that you have a right to control. Since you have the right to control, what's left is only a finance lease. What's left is only a finance lease wherein you need to recognize an asset. So that's the reason why under PFRS 16, there's no more operating lease on the part of the lessee because of this transfer of control. Remember, in an asset, what is important is the essence of control and not the ownership. So since the control here is passed by the lessor to the lessee should recognize an asset. Okay? So that's the reason why under PAS 17, there's operating lease, but in PFRS 16, no more operating lease because of this change in definition as to your right to control. Having established what is a lease and you know already that it is a contract, let's look into a bundled contract. What is a bundled contract? A bundled contract is a contract in which it contains your lease and non-lease components. If you still remember, you have discussed this one before in your past 41, past 40 investment property. So remember in your investment property, you need to separate contract regarding your investment property and on your different services provided. So such that you need to account properly on the amount for investment property and your services using your relative fair value method. What is your relative fair value method? Again, you allocate to each component on the basis of their standalone price or their fair value at contract inception. So here again in your lease, since this is a contract, if ever it is a bundled contract, meaning there is a lease and non-lease component, what do? We also separate them. You separate the lease and the non-lease component of the contract using the relative fair value. So just a quick recap on what is a relative fair value again. A relative fair value happens in case we have here lease, non-lease, let's say, and we have here your total contract price is 3 million pesos. So let's say your lease, the fair value is 1.8 million. The non-lease, the fair value is 700,000. So the total fair value is 2.5 million. So when we see relative fair value, you get the proportion out of the total fair value. So the lease, 1.8 million divided by 2.5 million multiplied by the price of 3 million. So what is the amount allocated now to the lease? 1.8 divided by 2.5 multiplied by 3 million will give us 2,160,000. So that's how your relative fair value works. So just like any other standard which has a bundled contract, in a lease, if there is a bundled contract, what is bundled here is the lease and non-lease component. So how should we allocate it? We use your relative fair value method. Now, let's start looking into accounting for your lease. Take note, in accounting for your lease, we account for two items. What are those again? Accounting for the lessee and accounting for the lessor. let's start with the accounting for the lessee. So lessee accounting. The general rule is we use your finance list. So when you say we use your finance list, we need to recognize an asset. So what is the asset recognized? The asset recognized is right of use of asset. So right of use of asset and then lease liability. So the time you enter into a lease for the lessee, take note the lessee is the one who rents. So once you enter into a contract of lease, you need to recognize these two items, the right of use of asset and the lease liability. Take note, since we are using finance lease, we are to recognize an asset. What do we call that asset? Right of use of asset. So generally, you enter on your books a debit to right of use of asset and a credit to your lease liability. Now, as an exception to the rule is that, meaning, as a rule, you use your finance list. But an exception to the rule in which you use your operating list is that if ever it is a low value asset. When we say low value asset, it depends on your materiality. So let's say a furniture is a low value asset. An equipment such as your computer is a low value asset. Another, if ever, it is a short-term lease. So if you are a lessee, guys, take note, if you are a lessee, remember these two items. If you can see a low value asset or a short-term lease, then use your operating lease. How does your operating lease works? Since this is a lease, generally, it means it is a rent. What you know in your rent is normally you have an income and your expense, rent income. Now, in financial accounting, your lease does not work that way. It works whether it is a finance or operating lease. Now, in your lessee accounting, as a rule, we said it is a finance lease. As an exemption to the rule, we use your operating lease. When low value asset and short term lease. How does your operating lease works? So instead of recognizing your lease liability and right of use of asset, here in your operating lease, every time there is a rent payment, what do? We recognize an expense. So your entry here is a rent expense in a credit to cash. So look guys, here in your lessee accounting, in your finance lease, we recognize both the asset and the liability. However, here in your operating lease, we do not recognize an asset and we do not recognize a liability. But what do we recognize? An expense. Okay, so I hope we're clear. As a rule, we use your finance list in which we recognize these items. As an exception to the rule, in case the list is of a low value asset or a short term lease, then you recognize only rent expense. So we said in your lessee accounting, we recognize two items, your right of use of asset and your lease liability. So two items only. So first, we need to determine what are the items of your right of use of asset and what are the items of a lease liability. Let's start first with the items of a right of use of asset. So the following are the items of a right of use of asset. First is your lease liability. Later, we will discuss what items are inside that lease liability. Plus, initial direct costs, plus estimated dismantling costs, less incentives before commencement of the lease, or you know this one as lease incentives. So, guys, as you can see, since right of use of asset, we recognize this is under your PAS 16 already because this is a property, plant, and equipment. How do we measure your property, plant, and equipment? At cost. So, since what you provide here is a liability, you include as part of the cost the liability. Of course, you already know that direct cost is part of the cost of an asset. Further, what is new here and seems that you have already encountered your estimated dismantling cost. What is this estimated dismantling cost again? This happens in case of your machinery, in which at the end of the life of the machinery or at the end of the property, plant, and equipment, you need to dismantle it so that you remove it in your premises. So since you need to dismantle it, you need to add that cost, estimated dismantling cost. But please take note, every time you meet an estimated dismantling cost, I've told this to my students before that your estimated dismantling cost should be computed at the present value of the dismantling liability. And lastly, we have your incentives or lease incentives. So anything that is given to your lessee at the start of your lease. Okay, so those are the items of your right of use of asset: lease liability, direct costs, estimated dismantling costs, and your lease incentives. So how do we make our entry as to these items? So first, to record your lease liability, take note, it increases your right of use of assets. So debit, right of use of asset, and you credit lease liability. Next, to record your initial direct costs. We debit right of use of asset and we credit cash for the payment of that initial direct cost. Next, for its estimated dismantling cost, how do we record it? We debit right of use of asset because it increases your right of use of asset, and we credit your dismantling liability. Take note, this dismantling liability should be measured at a present value. And then lastly, to record your lease incentives, we debit cash, we credit right of use of asset. Because as you can see, your lease incentives decreases your right of use of asset. Please remember the items of your right of use of asset: lease liability, initial direct cost, estimated dismantling cost, less lease incentives. We go now to your lease liability. How do we compute for your lease liability? Your lease liability is equal to your present value of your lease payments. The question here is what constitute your lease payments? So the following are the items which are considered lease payments. First, your fixed payments. What is this fixed payment? This is your fixed lease payment in which you pay every time you enter into the lease contract. So this is the actual rent you pay. So the rent payment are considered your fixed payment. So if you enter into a contract to pay 500,000 a year for the lease, the 500,000 is considered as the fixed payment. Next, we have your variable lease payments. So these are lease payments which is based on a condition in which if the condition is met, you pay an additional amount. So for example, guys, you enter into the lease and if your income is let's say 3 million, you pay additional lease payment of 50,000. So that additional lease is considered variable lease payments. Next, you have your guaranteed residual value by the lessee. So any residual value given by the lessee is equal to your any residual value which is guaranteed by the lessee is to be added on your lease liability. Sir, what do we mean by a guaranteed residual value? So at the end of the lease, take note the right of use will be given to the lessee, right? Okay. So since as the passage of time through the passage of time, what will happen to the asset? So since it is used by the lessee, of course, the performance of the asset will decline as time pass by. So the lessee should guarantee a certain amount that at the end of the lease term, the property will still have this value. We call that your guaranteed residual value or the residual value given by the lessee to the lessor. Next, we have your purchase option. What is this purchase option? This is the option given to the lessee to purchase the property at the end of the lease term. So for example, our lease term is 5 years. If in the clause regarding the contract that at the end of 5 years, the lessee has the right to purchase that property, we call that a purchase option. And then lastly, any penalties for terminating the lease. So these items are considered at your lease payments. Take note, we get it at your present value. Since we're talking about your present value, one thing that may come into your mind is what is the interest rate? The interest rate that we will use here in your lease liability is your lease rate implicit to the lease rate implicit to the lease. And if the rate is not given, if the rate implicit to the lease is not given, what rate should we use? we use your lessee's incremental borrowing rate. Okay, take note. Since we are measuring your lease payments at its present value, what is our interest rate? The rule is that first you get the rate implicit to the lease. If the rate implicit to the lease is not given, then look for your lessee's incremental borrowing rate. These rates will always be given by the problem. Okay, let's have an example. Take note, we are only to measure two items, your right of use of asset and your lease liability. So first, let's look into our problem. A lessee enters into a 10-year lease of a floor of a building with an option to extend for 5 years. Lease payments are 50,000 per year during the initial term and 55,000 per year during the optional period, all payable at the beginning of each year. To obtain the lease, lessee incurs initial direct cost of 20,000, of which 50,000 50,000, 15,000 relates to a payment to a former tenant, and the 5,000 relates to commission paid to real estate agent that arranged the lease. As an incentive to lessee for entering into the lease, incentive to the lessee, the lessor agrees to reimburse lessee a real estate commission of 5,000. At the commencement date, lessee concludes that it is not reasonably certain to exercise the option to extend the lease and therefore determines that the lease term is 10 years. The interest rate implicit in the lease is not readily determinable, but the lessee's incremental borrowing rate is 5% per annum. Okay, so let's look into this example. First, let's discuss what are the items of your right of use of asset again. The items of your right of use of asset is first your lease liability plus any initial direct cost plus any dismantling cost less any lease incentives. So with this problem, we can easily look into your initial direct cost. Ang sabi naman dyan, the initial direct cost is 20,000 pesos, which includes 50,000 pesos from your payment to tenant and 5,000 to a commission to your real estate agent. So your total initial direct cost is 20,000 pesos. Next, dismantling costs. If we try to look into your problem, there's no dismantling cost given, then this is zero. Next, your lease incentive. So we have here a lease incentive, sabi dyan, as an incentive to lessee for entering into the lease. The lessor agrees to reimburse to lessee the real estate commission of 5,000. So we have here lease incentive of 5,000. We go now on your lease liability. This is equal to your present value of your lease payments. Okay, so what do we have here in your present value of your lease payment? Here we only have a fixed payment. We have a 50,000 per year payment for the lease term. The lease term is 10 years. So how do we pay it? We pay the 50,000 every beginning of each year. So beginning of each year for 50,000 for 10 years, we then use present value of annuity due of 1, n is equal to 10 because the lease term is 10 years. And the interest rate, we said your interest rate is first your in rate implicit to the lease, the implicit rate. If the implicit rate is not given, we use the incremental borrowing rate of the lessee. Take note, it is the lessee's incremental borrowing rate. So what is the lessee's incremental borrowing rate? 5%. Of what amount? 50,000. So let's compute for the present value of annuity due of 1, n is equal to 10, I is equal to 5%, 50,000 pesos. Okay, so I hope you have computed this value 405,391.08 or 405,391 na lang. Yeah. So our lease liability is 405,391. How much is our total right of use of asset? 405,391 plus 20,000 less 5,000 will give us 420,391. How much is our lease liability? 305,391. Okay, let's make our entries for your right of use of asset. Okay, so first, for your lease liability, we debit right of use of asset, we credit lease liability 405,391. And then we record your initial direct costs. So your expenses, you debit expenses, no, you debit right of use of asset and you credit cash for your initial direct costs. Since there is no dismantling cost, we will not make any entry. Now, for your lease incentives, we debit cash, you credit right of use of asset, 5,000 pesos. Okay? So take note, we are to measure two items here. Right of use of asset, which includes these four items, and your lease liability, which is the present value of your lease payments, which is discounted using your rate implicit to the lease, if not given the incremental borrowing rate of the lessee. Take note, only the lessee's incremental borrowing rate. Okay. So that's how we initially measure it. Let's proceed to your subsequent measurements. So how do we subsequently measure your right of use of asset and your lease liability? So as I said a while back, your right of use of asset is to be accounted using your PAS 16, like a property, plant, and equipment. And under PAS 16, you use your cost model. Therefore, in your cost model, you have your depreciation. So take note, you have your depreciation expense here. So how will you depreciate it? You depreciate it at the lower of the useful life of the lease asset or the lease term. Lower of the life of the lease asset or the lease term. Or the lease term if ownership will transfer. Take note, it is always lower between the two, but if ever there is a transfer of ownership at the end of the lease contract, we use your lease term. That's how we will measure your right of use of asset. How about your lease liability? Your effective interest method. So how do we make your effective interest again? We have your payments. We have your interest expense. And then we have your amortization. How to compute again for your interest expense? Your interest expense is computed as equal to your lease liability multiplied by your rate. Your payments, these are your lease payments. Okay. So we already discussed how to use your effective interest method. Further, guys, your lease liability can be classified as current or non-current. And I know that you already know how to classify the current portion and the non-current portion using your effective interest method. So therefore, guys, in your subsequent measurement, we measure two expenses. So what are those two expenses? First, your depreciation expense because of your right of use of asset and your interest expense for your lease liability. Okay? Depreciation comes from your right of use, and on your lease liability, we have your interest expense. Okay? Let's look into our measurement here under your previous problem. A while back, we have measured our right of use of asset at 420,391. And our lease liability, we have measured it at 405,391. Still remember? Okay, we go back. We measure our lease liability initially at 405,391 and our right of use of asset at 420,391. So we go here. Right of use of asset 420,391, lease liability 405,391. So on your year zero, the beginning balance is 405,391. However, since we pay at the beginning of the period, we pay the 50,000 initially. What is left now is 355,391. Okay? And let's say this is January 1, year 1. So on December 31, year 1, you will amortize it for 1 year. So 355,391, you will not have a lease payment because your lease payment is every January 1, year 1. So our interest expense is 17,770. That is based on your 5% interest. Okay? You already know how to measure the lease liability. I don't have any problem with your effective interest method. My main issue here is for you to properly measure the right of use of asset and the lease liability amount. For your right of use of asset, take note, we will only depreciate it. We depreciate it using your lease term or your useful life, whichever is lower. So we have here your 10 years. Our lease term a while back is 10 years. So if you still remember in the PV, we use N as 10. Therefore, our lease term is 10 years. So 10 years is the life. So 42391, that is our right of use of asset initially, divided by 10. What is our annual depreciation? Our annual depreciation is equal to 42,039. Right? So every year, yeah. Interest expense, you already know this one. You base it on your carrying amount multiplied by your effective interest. The effective interest in this case is your incremental borrowing rate of the lessee or the rate implicit to the lease. Okay, let's wrap up your leases under your lessee. So for lessee accounting, generally, we use your finance lease. And under finance lease, we recognize two items, your right of use of asset and your lease liability. Your right of use of asset, again, is to be measured at your lease liability plus initial direct cost plus dismantling cost less lease incentives. Your lease liability is to be measured at the present value of your lease payments. You already know the items of your lease payments. So you need to discount this one using your rate implicit to the lease or less its incremental borrowing rate. And you use your operating lease if in case it is a low value asset or a short-term lease. When we say it is a short-term lease, it is less than 12 months. Take note, in a finance lease, we recognize two expenses. Your depreciation expense for your right of use of asset and your interest expense for your lease liability. While in your operating lease, we only recognize one expense. That is your rent expense. That's it for our uh, lease for your lessee accounting.